Good morning, everybody. We'll start with a revisit of the whole thing. See, if you start a business, you need to understand how much money you need. You need money for creating infrastructure on one side, for producing or providing the product or providing the service. We mentioned about software company, that is on one side, that is infrastructure. Those are all fixed assets and are called long-term asset. On the other hand, you need working capital, meaning for manufacturing goods or for dispensing service, you need to have some assets. The assets that you convert into finished products like raw material, goods in process, even finished goods. Then asset also includes accounts receivable. Why it should include under asset account? What are accounts receivable? When you sell something, just imagine that you are running this stationery shop in your hostel. Now suppose some customer comes, maybe he's a student, and then he purchases a pen for say 20 rupees. Now he says that, oh my God, I forgot my purse. So just write it in your khata, I'll give the money later. So the moment you write it on your khata and this guy puts his signature that I acknowledge that I'm supposed to pay you 20 rupees at some point of time in the future, he becomes an accounts receivable, meaning you are supposed to receive money. Now, if just imagine that you have only 100 pens in your store. And yes. What is happening? Now, suppose you have 100 pens in your store. Something is wrong. Why there is an echo? Hello? I think it's okay now. Nalla Siva Krishna. This is too much. You're doing something else in the class. You can log out if you have something more important to do. Okay, so on the other side, account receivable. Account receivables are important because, are asset because you have applied some money to buy those pens and the pens are out of your stock. So the value of the pen should be either in the form of cash is an asset, or you write it down in a khata and then you say that this is the money I'm supposed to receive. So that becomes accounts receivable, and that is why it is asset, because you have already spent money. Remember that all the assets are those where you have already invested some money. Liabilities are those where you have to pay back. There is some kind of, some kind of future responsibility that you have to pay them. Now we have seen that our total infrastructural requirement is 1500 rupees, including a table, a rack, and a chair, etc. So 3000, that was 1500. And then we have also seen that we need about 5500 rupees worth of current asset or stocks and cash. These are all current assets. So total we need 7000 rupees. Now you have checked that you have only 3000 rupees with you, so you borrowed 4000 rupees. If you borrow money from a bank or from any money lender, they are going to tell you that you have to pay interest. Private money lender charge interest at a very high rate. Suppose like Kabliwalas or even nowadays local people have become money lender, they will be charging something like 2 rupees, 3 rupees per month per 100. So if it is 3 rupees per 100, then it becomes something like 40% in a year if you compound them. But these are all prevalent even in formal systems. Suppose you buy something using your credit card and then you don't pay up in time. then you have to pay interest at the rate of something like 3 rupees a month. It will eventually amount to about 40%. Credit card interest rate is 36 to 40% on an average. So you should never ever be defaulter in a credit card. If you buy something today, you should know what is your repayment schedule. Before the repayment date comes, you should immediately pay. Otherwise, you'll have to pay interest from the day you buy. So be very careful. This is called interest. If you buy something on installment from some company, usually the finance companies.
उसको बोले नहीं कि हम ना हो रही वन खराब वार्ड मेंबर में क्या चिंता कर रही थी हमरा पॉलिटिक्स के लिए टाइम है यार
आयुष
हाँ होगा नहीं वो इसलिए
Ayush Kumar. I have to note down the name. Just a second. Okay. So Ayush is a repeated defaulter. He has been doing it for the period of the classes. So you borrow money, you have to pay interest. Now your balance sheet will look like this. You have cash, you have inventory, that means you have purchased 5,000 rupees worth of goods. Then you have furniture fixture and total asset becomes 7,000 rupees. And you have 3,000 rupees in with you and you have borrowed 4,000 rupees. So total becomes 7,000 rupees. You have now started the business. This is all we have seen. Now suppose this is an exercise. You have at the end of the year, you have made a sales of 5 lakh rupees. You have seen that for everything there is a book called ledger. So whenever you buy something, you register that in the ledger that I have bought so and so goods on so and so date from so and so party for so and so rupees. Similarly, when you sell something at the end of the day, or maybe whenever you make a sales, if you are using a software or a billing machine, you definitely write that. Otherwise, it will be very difficult to remember. So everything is written. At the end of the year, you have all the data at your fingertips. Like sales, you have 5 lakh. If you see that total sales is 5 lakh rupees, total purchase of material is 2,50,000, and the like. You have hired a person and you are paying salary of 60,000 rupees a year, rent, etc. So now you want to sit down and prepare your profitability statement. Profitability is not so easy. You have to take stock of all the expenses and all the incomes, etc. You have to estimate the depreciation as well. And only then you can find out the profit. Now, before you even sit down to estimate the profit, the first thing just before that is to estimate the depreciation. Depreciation is the contribution of the machine to the current year's business. Your machinery, your all fixed assets, they contribute to the business. They facilitate the business. Now, what is their contribution during the current year is depreciation, because gradually they will lose value. At the end of their life, nothing will remain. So whatever is the purchase price, you want to recover that over a period of time. So this is called use up. You have used up a percentage of the machinery or other fixed asset during the year, and you want to charge that in the profit loss account as expense. You have spent that money, meaning you have spent a part of your fixed asset during the year. That is what is depreciation. So for furniture and for depreciation, there is always some rates. It varies. Before that, let me tell you something very important. I may forget to mention this some other time, but just remember this. This is very important. That is, all the companies, without any exception, prepare two sets of accounts. Even public sector companies, which are government owned by president. All the public sector companies are owned by the President of India. Even IIT Kharagpur or any other IIT is owned by the President of India. all the land in the country belongs to the President of India. We just take a kind of a lease, almost like a lease when you buy the land. It still belongs to the President of India. We are not the owner. Okay. Now, all the companies, they prepare two sets of accounts. One set for income tax purposes, where they want to show as little profit as possible, because if they show more profit, they have to pay more taxes. Moving forward, I'll show you how the taxes are calculated. And another set of accounts are prepared for those who are interested in your profit rather than tax. Like bank is interested in the profit, your shareholders are interested in the profit, your other lenders, your investors are interested in the profit. So you try to jack up your profit as much as possible to make these people feel comfortable, but without doing any hera-feri. There are authentic system, there are legal ways of showing more profit and showing less profit. You have to be within the legal boundaries. So for depreciation, there are different rates. One rate is maintained by income tax department. So they say that if you buy a computer, you can depreciate that at 33%. Whereas our accounting system is managed by Chartered Accountant Institute of Chartered Accountant of India, Ministry of Corporate Affairs. Then there are some IIMs which are also part of this consortium. They decide what should be the depreciation rate, what should be the treatment of all other entries in the books of accounts. So there are bodies. There is a body, a central or apex body for deciding on accounting systems, and we follow them. So for depreciation, some leverage is given to the companies that while preparing them, if you want to show higher profit to say your stakeholders, external stakeholders, then you can show higher profit using this. Who is this guy? Others Kumar, can you hear me? Others Kumar? Hello? Can you hear me? Others Kumar. Okay, you have to bear with people who have less etiquettes. Now, okay, so these are the data that are given. Now for depreciation, we'll have a separate session maybe, or maybe during some other time, maybe I'll talk more about, depreciation is to be defined. So there will be a separate session on depreciation. For the time being, you just know that all the fixed assets except land is not depreciated. So remember this absolutely clearly and for good, that land is never depreciated, because land value normally is not get depleted, meaning suppose today land value is something, next year it will normally go up, but you don't normally show higher value. Normally whatever is the value in the books of accounts, you maintain that throughout the life of the company, unless you do a revaluation that has a process. But for usual process, we normally do not revalue anything. You can revalue anything and everything. You can revalue your plant and machinery also for a different purpose. That is beside the point. For the timing, you know that land is not depreciated. Now for furniture, there may be one rate of depreciation. For machinery, there may be another rate of depreciation. Like for income tax purposes, furniture will be depreciated at the rate of 5%. Building will be depreciated at the rate of 5%. Machinery will be depreciated at the rate of varying percentage, like computer 33%, gas cylinder 100%, say pollution control equipment 100%. Those are 100% items are allowed because government of any government for that matter, particularly government of India, they want that you invest more money in computers, more money in in pollution control equipment so that you do some social job as well. Why computer is depreciated 33%? Because computer is aging too fast, meaning they're becoming obsolete too fast. That is why traditionally thinking that computers will be obsolete after every 3 years. That is why they allow 33% depreciation. In fact, in US, big companies, means from my experience only, I cannot say about China and other countries, European countries, but big companies in the US, they normally not recycle. They normally replace the computers almost every year. They will give you a personal computer, you use it for the year, next year you will be finding new machines on your table, even laptops. So old machines will be just discarded or maybe sold or something, I don't know. So there's thinking that computer becomes obsolete even though they are running, but then the whole thing becomes new, and then some operating systems, some apps will not work on the old computer, whatever. So here for this example, I am taking a uniform depreciation rate of 10%. So furniture 1500 rupees, depreciation is 10%. Billing machine 10,000 rupees, depreciation is 10%. Now the original value is 1500. During the year, you think that 10% of the value has been reduced. So you apply 10% depreciation, so it becomes 150 rupees. So after depreciation, the value becomes 1350. If you reduce 150 from 1500, that means the furniture has now a book value of 1350. At the time of buying, it was 1500, but then during the year, the furniture has contributed to the business to the extent of 150 rupees. That means 150 rupees of the value of the furniture is gone. So now present book value becomes 1350. Similarly, billing machine cost us 10,000 rupees. You apply depreciation at the rate of 10%, that means 1000. Then book value becomes whatever is the book value at the beginning of the year minus depreciation. So beginning of the year book value was 10,000. During the year, the billing machine has reduced its value because of wear and tear, or because it has contributed to the business to the extent of the amount of depreciation, that is 1000. So 1000 becomes an expense, because that is the expense you have incurred for the billing machine to the business. Book value becomes 10,000 minus 1000, so 9,000. So total depreciation becomes 150 for furniture, 1000 for billing machine, so total is 1150. So that is why I have written depreciation here as 1150. So this will not be given, you have to estimate that. Closing cash also is normally not known unless you prepare the cash flow statement. I will cover that later. We have seen that there are different kinds of profit, like gross profit, operating profit, net profit, EBITDA, EBIT. There are many other nomenclature, but then don't worry about them. Once you know all of this, if you know the meaning of them, then you can always estimate. Like EBITDA, EBITDA. E means profit. So profit before interest, tax, depreciation, amortization. That means when you talk about gross profit, if you find that there is any expense in that in the form of anything other than interest, tax, depreciation, amortization, then you should reduce that. For example, suppose you know operating profit. What is operating profit? Gross profit minus all other operating expenses. What are operating expenses? All operating expenses plus depreciation plus amortization. So you just deduct depreciation, amortization from operating profit, you get EBITDA. As simple as that. So if you know the meaning of all the profits, it's very simple to do. Why different types of profits I have already explained, and I have explained it with this example, so there's no point repeating the same thing. And I also said this is also very important, that balance sheet pertains to certain date, say 31st March of a year. So you prepare a balance sheet at the beginning or at the end of the year. So at the end of the previous year, you prepare another one. At the end of the current year, you prepare another at the end of the next year. In between, during the year, you make a lot of sales, you make a lot of purchase, and in the process, you actually do a lot of operation. And if you subtract all the expenses from the sales that you make during the year, then you estimate the profit. That is how you estimate the profit. Okay. Now, one thing needs to be understood very clearly if you want to understand gross profit. That is, gross profit is nothing but sales minus cost of goods sold. Now, what is the cost of goods sold? What is it? Number one is the goods that you buy during the year. But then from the previous year, like previous year when you prepared the balance sheet, you found that 5,500 worth of goods were there lying in the stock. Suppose it is your stationery shop, that means in the room itself, you find that 5,500 rupees worth of stock is there at the time you went to bed on 31st March 2020. Now, when you woke up on 1st of April, that is the next year, beginning of the next year, what you will see the same thing lying there in your room. Nobody came during the night time. At 12 o'clock, you went to bed. The next moment, the new year starts. So, previous year's closing stock becomes current year's opening stock. This is the stock with which you open the business. During the whole year, you do a lot of business. Then at the end of the year, you find that some stocks remains unsold. That becomes the closing stock of this year, which again becomes the opening stock of the next year. So this should be understood very clearly, because when you will be estimating gross profit, then you have to deduct cost of goods sold from sales. Cost of goods is equal to nothing but the purchase of stock that you do during the whole year, plus the stock that you inherited from the previous year, minus the stock that you could not sell during the year. So purchase plus opening stock minus closing stock. Try to understand, don't memorize. It's so simple. Then you get total cost of the goods that you sold. Cost of the goods that you sold for how much? That is the sales. So opening stock is 5,000, purchase is 2,50,000, closing stock is 10,000. This example is different than this. I should have put the same data, but for whatever reason I put a different data. Next class I have to make this change. This comes from the previous example that we are talking about, that opening stock was 5,000 with which you started the business. You made a purchase of 2,50,000, then closing stock at the time of closing you found it is 10,000. So you have actually, now you can estimate the cost of goods sold. Let me do it now itself, otherwise I may forget. Last year also I made this mistake and then I never made the change. And hopefully everything is right. So next year, you estimate them, so you get the total cost of the goods sold is 2,45,000. Now, this is again to demonstrate that closing stock of previous years become opening stock of the current year, then closing stock of the current year becomes opening stock of the previous year, etc., etc. Because usually students make mistake, even though the concept is so simple, but then it's confusing as well. So that is why I have too many slides on them. Now your sales is 5 lakh rupees, your cost of goods sold is 2,45,000 rupees, you deduct and you get 2,55,000 rupees to be your gross profit. Now this is a depreciation of the definition of the depreciation. Depreciation is nothing but apportioning of the total cost of an asset over a period of time. You buy the asset spending money, but then you cannot charge the entire cost in a particular year as expense. Anything that you buy, you have to charge the profit loss account to recover the money. How do you recover? When you make a sales, customer pays you some price, and that way you are transferring the cost in the hands of the customer, to the pockets of the customer. Get this? You buy raw material, you buy machine, you pay a salary, you incur so much of costs that you incur. At the time of selling, all the costs are transmitted to the customer. The more efficiently you can transmit this cost to the customer, the more profit you will make. Suppose the customer makes a payment of 100 rupees, you transfer maybe 50 rupees of cost. Then rest of the amount is the profit. 100 minus 50. But then suppose your cost is 60, suppose cost is 150. You have shifted only 100 rupees to the customer. Then you incur a loss of 50 rupees. So you have to cut down the cost from 150 to below 100 to make a profit. So that is how profitability happens. Okay, there are definitions. You can read them later. Businesses depreciate assets, long-term asset in particular, differently for two different accounting purposes. I have already told you, for income tax and for reporting to usual stakeholders. Depreciation is a process of charging the profit loss account the loss that you incur for using the long-term asset. Okay, you are using the loan. Suppose you buy a Xerox machine. This is a better example. Suppose you buy a Xerox machine. Now, suppose the Xerox machine cost is 5 lakh rupees. Now, during the year, you made a sales of, say, 3 lakh rupees. You made a sales of 3 lakh rupees. Now, your cost was, suppose, only 1 lakh rupees. So you may think that I made a profit of 2 lakh rupees because my sales is 3 lakh and all my other expenses are only 1 lakh, including rent, including interest, including everything. Not depreciation. Not depreciation. Now, at the end of the year, you may feel that, my God, I made a profit of 2 lakh rupees. Now, suppose something happens to the Xerox machine, it doesn't run and it goes kaput absolutely forever. What is your profit and gains? You invested 5 lakh rupees on the Xerox machine and you have not recovered that in the first year. You recovered how much? 3 lakh rupees of sales minus 1 lakh rupees of expenses. So only 2 lakh. Your loss is 3 lakh rupees. Loss is 3 lakh, 5 lakh minus 2 lakh profit. 2 lakh only came to your pocket. 5 lakh rupees went out of your pocket. That is why you have to charge depreciation to your sales. So sales is 5 lakh. Now, if you buy a Xerox machine for 5 lakh rupees, you make depreciation of maybe 1 lakh rupees a year. So if total expenses during the year was 1 lakh without depreciation, now you add depreciation to that. So it becomes total 2 lakh. Your sales is 3 lakh. 3 lakhs minus 2 lakh, your actual profit is only 1 lakh. That doesn't change the situation. If the Xerox machine goes kaput permanently, you are at a loss, that is for sure. But then if you keep on charging depreciation and the Xerox machine goes kaput in the 5th year or later, you have already recovered. You will not have a wrong notion of profit. Earlier, you had a wrong notion of profit that you made a profit of 2 lakh rupees. It is not. You forgot to charge the Xerox machine cost on the profit loss account. Now you charge it. Your actual profit is 1 lakh. So you can take home only 1 lakh, not 2 lakhs. Rest 1 lakh has not been paid to anybody now. So that is why it is called non-cash expense. This money remains with you. You don't take it home, but it remains in the business. So these depreciation and amortization is nothing but non-cash expense. Remember this. I have to be faster. So this is how depreciation has been estimated. I have shown that earlier also. So let us not repeat that. Now, at the end of the year, we have all these expenses. Let us do the the profitability statement. We have already estimated the gross profit. So this is salary. Okay, now let us see what are the operating expenses. Gross profit is done. Now we have 2,55,000 rupees of gross profit. We want to estimate what is our operating profit. Now salary is 60,000, rent is 12,000. These are operating expenses. What are operating expenses? The expenses that you incur and forget about it. It is gone. It is gone out of your company. So it is gone means rent you have already paid during the year. Transportation expenses you have already paid. Telephone expenses already paid. Electricity already paid. Suppose you buy a telephone. That is not an expense during the year because telephone remains with you for a long time. Anything you incur and you pay and you consume during the entirely during the year is part of operating expenses. Anything you incur, any expense you incur, but then the machine or the asset remains for a long term with you, that is not part of the operating expense. So I'll show you that moving forward. Let me see how quickly I can do that. Salary is an operating expense because you pay it and forget it. There is no after effect of that. Rent gone, transportation expenses paid, and you have received the goods and you forget about it. Telephone charge, this is not telephone purchase, telephone expenses. Then electricity, I should write telephone expenses. I don't know if it is in Excel. No, this is not in Excel. This is in Excel, but I have to double click and then it will come. Then it's a whole lot of problems. So let me just do it since I have told you that. Let me do it. So telephone expenses. Now, all those are operating expenses. Add them up, including depreciation. Remember and notice carefully that depreciation and amortization is very much part of your operating expenses. Depreciation and amortization is very much a part of your operating expenses. All of them together, it's 92,150. That is your operating expenses. This is to be deducted from gross profit to get operating profit. What was the gross profit? 2,55,000 rupees minus 92,000 rupees. You get operating profit of 1,62,850 rupees. Now, before you estimate profit before tax, you have to deduct interest from here. You borrowed 40,000 rupees, 4,000 rupees, and the guy told you that you have to pay interest at the rate of 10%. Was it 10%? Then it should be 400. Why it should be 40? I made a serious mistake. Is it 10%? Did I mention? Okay, whatever. I should not do the correction now. It should be 400. So interest is 10% or say 1%. Let us say 1% for argument's sake. Interest is 1% on your 4,000 rupees. I thought it was 400. 4,000 rupees. So annual interest is 40 rupees. So you deduct 40 rupees from operating profit. Then you get profit before tax. That is 1,62,810. Okay. So this is operating profit. Profit before tax. Now, every profit, operating profit, you can estimate a percentage or margin. Percentage is called margin. So what is operating profit margin? 1,62,850 divided by what? Not gross profit. Don't make this mistake. Divided by 5 lakh. That is sales. I said denominator is always sales. Okay. Even profit before tax is 1,62,810. And percentage is that divided by sales. Net profit. Now you pay income tax at the rate of 20%. For argument's sake, actual rate may vary. It may vary from 17 to 22%. And then there is some surcharge also. So profit before tax is 1,62,000. Income tax rate is 20%. Charge income tax on that. So that is 32,562. So net profit will become 1,30,248. This is your money. This is the money that belongs to the owners. Even though we made a profit of 2,55,000 rupees gross profit, those money do not belong to you. Those belong to the company. Now, after all the expenses, the company tells you that I am now left with 1,30,248. This belongs to the owners. So this belongs to you. The business is telling you that this money belongs to you. You can do anything with that. If you want to use it for purchase of your groceries or something, then you have to take this money in the form of dividend. I cannot give you money just like that. You cannot actually draw money just like that. You have to formally pass a bill or a voucher by saying that payment of dividend to the founder. You cannot say payment to dividend to me, because the company is making this voucher. The company will say payment of dividend to the founders. Rupees, suppose it is 1 lakh, rupees 1 lakh. Then 1 lakh will go away from here. Remaining 30,248 will remain as reserves or retained profit or retained earning. Okay. Or it goes to profit loss account. In the balance sheet, you might see that some people maintain something that they call profit loss account. That is nothing but reserves and surplus, accumulated profit. Yes. Yes.
Generally, the profit is calculated for cost price, right, sir?
What is it? I didn't get it.
Generally, profit percent is calculated on cost price, right?
No. Profit is estimated on sales. Always. This is the example that I gave. You made some sales of stationaries and you earn 5 lakh rupees. Now, out of 5 lakh, if you are making a net profit of 1,30,248, then your profit percentage is 1,30,248 divided by 5 lakh. Because why profit is estimated not on cost but on sales is like what percentage of sales is your profit? That is the percentage. What percentage of sales is your gross profit? What percentage of sales is your operating profit? So that is why denominator is always sales. There's no doubt about it. Okay, so
Okay.
if you have residual doubt, let us discuss that during tutorial. I'll be offering tutorial maybe either tomorrow or day after. I'll talk about it at the end of the class.
Okay, sir.
Then suppose you pay dividend of 50,000 and then the net profit minus dividend is the retained earning or retained profit, or it goes to the reserves and surplus. This amount belongs to the owner. All the money, dividend as well as the retained earning. Net profit belongs to the owner. Therefore, it is added to owner's equity in the form of retained profit or reserves and surplus. The 80,000. 80,000 goes into reserves and surplus. Okay. Now, let us see how the balance sheet looks like at the end of 1 year of operation. See, the cash will be available after you do a cash flow. I'm not doing it because that will add to the complexity. We'll do that in a separate class. Cash flow will be a separate class. Now, I'm just providing the data that cash position is 45,645. First of all, we estimate the assets. What are assets? This is the format for asset. I'll give you a larger, more complex format, more comprehensive format later. But for the time being, you know that first, when you write balance sheet, first is asset. Among assets, the first item will be the most liquid asset. Cash is the most liquid asset. Then accounts receivable, because that will be converted into cash very quickly. Then inventory, that is raw material. You can somehow sell raw material at some point of time, so that becomes the third most liquid asset. Then comes furniture fixture. This is very difficult to sell. That is why they are less liquid. Now we start with cash. Cash will be given. Accounts receivable has already been given because this data comes from your books of accounts. Every day, whenever you sell something, if somebody buys something on credit, you add them in the books of receivables. So receivable at the end of the year becomes available data. Use that data. Inventory also. Now fixed asset. Furniture fixture, it is not 1500 with which you bought. During the year, the furniture lost value, that is equivalent to depreciation. So we estimated depreciation of 150. So now book value, which is the value that goes into balance sheet. Again, there are mistakes. This is 2021. Okay, I'll do that later. So changing date is a huge thing. Now, as on 2019, this is the balance sheet, and your all fixed asset will be demonstrated or shown at the book value at the end of the year. That means earlier year book value minus depreciation. So that becomes the book value. Whatever is presented in the balance sheet is the book value. Similarly, machinery, the purchase price was 10,000 rupees. That means previous year value was 10,000. Then you apply depreciation of 10%, that is 1,000. So 9,000 is left. So 80,000 total is 80,995. That is the total asset. So on that day, if somebody asks you what is the value of the asset as of date, so you're going to tell him or her that my asset value today is 80,995. Now the liability side. As I said, the most liquid thing comes first, but then here equity has been shown at the bottom. Whatever. So if I am following this template, then you also follow this template. So we start with accounts payable. This data is given already. There is no loan from outside other than loan from the friend. Your friend gave you 4,000 rupees and you are paying interest. So you thought, I have made some profit during the year. Let me repay part of the loan. So you went to your friend and then gave him 2,000 rupees. That you gave me 4,000 rupees. Thank you so much. I have made some profit. So you take back 2,000 this year. I'll pay you the remaining 2,000 next year. And he is happy because you repaid the interest also. So 40 rupees of interest plus 2,000. So you paid 2,040. But loan principal amount is 4,000. You paid 2,000. So what is remaining outstanding loan amount is 2,000. Okay. Now owner's equity capital. remember always that equity capital is never affected by your operation of the business. So that normally remains fixed unless explicitly you are bringing in new money. If you bring in new money, equity capital will go up. If you normally you don't take away equity capital, that is why normally equity capital does not go down. Normally they're always there like that. Suppose in some years there are so much of loss, etc., etc., then you can write off some of the equity capital that comes on merger acquisition and restructuring. These are all very specific things, not regular thing. So you don't really do that. Now, retained profit is earlier year you had some retained profit, perhaps zero. Earlier year it was zero. But this year retained profit is 80,000. That goes to balance sheet. So you add that with zero and why this is 63,000. Whatever, I'll check that. So total becomes 80,995. I think this is 63,000. Maybe some mistake. How could I forget that? Okay, so this is the balance sheet placed side by side, or in this is called column shape. But earlier during my student life, we used to have a T shape. Assets will be on your left, liabilities will be on your right, or other way around. But now these are all in a column shape. So everything placed in one sheet, assets and liability. This is the Reliance Industries Limited balance sheet as on 31st March 2020. 2021 is yet to come. So you can see the entries. There are many entries. It's not as simple as I showed, but then you will connect with them. The major heads are all same. This is income statement, profit loss account. So this is total income, and then total expenses, cost of material, purchase of stock, then excise duty. Normally nowadays there is no excise duty outside excisable items, like petrol is an excisable item. Employee salary, benefit, finance cost is interest, depreciation, etc., etc. Then they get profit before tax directly. They don't estimate operating profit. Who will estimate operating profit? The analyst will take this data, then they will recast the profit loss account. They will estimate EBITDA, then operating profit, profit before tax, the net profit, because they want to compare Reliance Industries with maybe ONGC or with maybe Hindustan, say, Petroleum or IOC or Indian Oil, something like that. For that purpose, they will recast the balance sheet profit loss account. And this is how the balance sheet looks like. Asset comes first, liabilities come later. Asset, on the asset side, there is non-current asset, and they start with property, plant and equipment. Then eventually they come to cash. Cash comes at the end, whereas I showed cash at the beginning. So whatever tradition you follow, you have to follow that consistently. Otherwise investors will be upset. Now in liability side, thankfully or whatever, peculiarly, they started with equity capital. So equity capital comes first. Their equity capital is 6,339 crore rupees. Earlier year it was 5,926. Then they say other equity. If you go to other equity schedule, this 14 is schedule. You see that schedule, you will find this 4,46,990 crore, humongous amount of money. This is nothing but reserves and surplus. Profit is plowed back. So they call it other equity. Nowadays, I see that majority of the balance sheet, other equity is mentioned, where I refer to as reserves and surplus. Okay, so this is how it looks like. Then comes cash flow statement. Nothing new is here. There are three streams of cash flow. One is operating activity, this one, then investment activity and financing activities. And then whatever is the total resultant balance of the three, that you add to the previous year's cash balance to get current year's cash balance as on the end of the business. This is the cash flow statement of Reliance Industries. You can see that leisurely later. For any additional reading, you can visit www.mca.gov.in. It is Ministry of Corporate Affairs. They provide wonderful material for startups, for businesses, even on accounting. There are tutorials on accounting, etc., etc., so that anybody who is starting a business can start by obtaining knowledge from here. He doesn't have to go elsewhere. Now, cash flow can be estimated in the indirect method. Say operating cash flow, sorry, directly and indirectly. Direct method takes into account all the transactions that you make, like profit loss account, whatever you show, all comes here. That is why that is very complex. Both estimates the same thing, estimate the same cash flow. That is why normally people in the classes, at least, they use indirect method, where you start from net profit, not from sales. Whereas in direct method, you start with sales, then you deduct salary, deduct rent, everything you show here. Whereas indirect method starts with net profit. I said depreciation is a non-cash expense. That is why in cash flow, this remains as cash. So you have to plow it back. That is why you add depreciation and amortization. Yeah. Suppose during the year you sell some machine. If there is a profit or loss, then if there is a loss, you add that because it is consuming your cash. If there is a gain, you subtract that. Then you deduct increase in current asset, meaning that suppose you buy some raw material and last year's raw material stock is less than this year's raw material stock. That means some money has gone into raw material. So that is some cash that is not reflected in your cash position now. So, and that has consumed some cash. If inventory goes up, that has consumed cash, so you deduct that. If current asset goes down, that means some cash has been released, you add them. Similarly, current liabilities, if it goes up, that means some money has come from outside the company, you add it. If it goes down, then you deduct it. Okay. Cash flow from investment activity is cash flow from expenditure, capital expenditure, meaning suppose you buy some machine, etc., and you make some investment in fixed deposit or something. Cash flow from financing activities, these are all borrowing and equity funding, and then dividend payment. Dividend payment is a negative cash payment. Net investment in some debt securities or something is a negative. And then if you bring some money in the form of equity, that is a positive. And if you bring in money in the form of, actually there should be plus fresh induction. You induce some fresh equity, that also is a positive cash flow. So these are usually operating activities cash flow. So you need to remember this, otherwise it becomes difficult. And this is the steps in cash flows. Some this thing, but class is not over. Please don't disperse. Please don't disperse. This particular presentation is over. I have to upload another document. Just a minute. Okay, so yeah, hope you can see this. See, this is an Excel sheet for your understanding. I have prepared this profit loss account, and then balance sheet, and then cash flow statement. So everything is done based on some data given. Let us see how much I can cover. Suppose you run a company, not a stationery shop, but some bigger company, and I'm providing you the annual data, meaning whatever you have done, all the general ledger balance is available. That is what I am mentioning, that operational data is available, and whatever was the balance sheet in the past year, whatever data you will be requiring for preparing current year's profit loss account and balance sheet are given. So how do you estimate the profit loss account? How do you prepare the balance sheet? Let us move forward. Now these are the expenses which are given. Now there are some color code, not so important. Actually, during the class itself, I converted the color. Now whatever is the operating expenses, you have to identify it fast. Give them a different color will be better. Payment of rent is an operating expense because you incur that during the year, and no impact remains afterwards. So this is an operational income. Advertisement expenses is also an operational expense because you incur advertisement expense. If it is a small sum, then nothing remains. Suppose you advertise in a Durga Puja pandal. So who will remember you after a year? But suppose you incur 1 crore rupees to make an advertisement in the national TV channel or somewhere, or you continuously advertise to make a brand, that remains with you for a long time. In that case, advertisement will be a long-term expense, like fixed asset. And that cost will be amortized, meaning just like depreciation, you will be allocating a small part of it every year. We'll call it amortization, not depreciation. The basic difference between depreciation and amortization, though they are same, but depreciation is on fixed asset, amortization is on intellectual capital. Like say advertisement, you create a brand, you invest some money in research and development, that creates IP. So that also is a long-term asset because you enjoy the benefit over a long term. Purchase of equipment remains with you for a long time. That is why purchase of equipment is not an operating expense. Salary is an operating expense because you pay salary and you forget about it. It's paid every year. Closing a stock is not an operating expense. Closing stock is not an operating expense. In fact, this is a fixed asset. So let us put it in blue so that we identify all the, or maybe say we put it in this color. Now, transportation expense is an operating expense because you pay transporter and he goes off and nothing remains. Maintenance and operating expense. Then legal expense also is an operating expense. Purchase of goods is not an operating expense. Why? Because it remains with you for a long time. So this remains with you for a long time. Let us put it in green. Construction of factory shed. Factory shed also remains with you for a long time. Purchase of truck remains with you for a long time. So these are fixed assets. Truck hiring charge. You pay somebody for hiring truck for a day or something. Amortization and preliminary pre-operative, I mentioned, this is fixed asset, long-term asset. Repayment of bank loan is very different. It is neither expense nor fixed. This is just paid to the bank. It goes from the balance sheet. You don't have to do anything. Trade receivable is a balance sheet item and it is not an expense. Telephone bill payment is an expense and you pay it and forget. That is why this is an operating expense. Purchase of telephone is a fixed asset because telephone will remain with you for a long time. That is why telephone is a fixed asset, long-term asset. It's not an expense. Electricity bill payment is an expense and you forget about it after. So this is part of operating expense. Closing cash normally is not given. I have given because I had to do it to prepare the balance sheet. Normally it will not be given. You have to estimate cash flow statement only to get it. Insurance is definitely an operating expense. Audit fee and an operating expense. Fresh long-term loan raise. Yeah.
So why repayment of bank loan is not an operational expense?
Because you borrowed the money, you are using it for business, but then at the end of the year you have to pay. Suppose you have borrowed 400 rupees from your friend, whatever profit you make or it will cost you incur, your friend will always ask you to return that money. He will not say that, okay, you have done your business with my money, so okay, fine, thank you. He is not going to say. At every moment you will be meeting him, he will remind, guy, you took 400 rupees from me. Why are you not returning? You return in installment. Like this year you return 200, next year you return 200. So that remains intact. And that 200 goes from the balance sheet. It is not an expense because you got that money at the beginning and you are merely returning the same money. You are not returning from anywhere else. Whatever money he gave, you did the business with that, but that money remained in the business. You are merely returning the same money. Hope you understand. Else we have to wait for the tutorial. Otherwise, I won't be able to finish anything. First, long-term raise is again a balance sheet item. Trade payable is a balance sheet item. You have to repay that guy you took stock from him. Traveling expenses is an operating expense. Stationery is operating expense. Dividend is not an expense because this is the money you pay to the owner. So it's absolutely different. Founders contribute to equity capital also is different. It is not an operating expense. Company pays income tax. Tax comes later. This is not an operating expense. Then outstanding in short-term bank loan is 9,900. My God, where is the interest? Yeah, here is the interest. Interest paid to the bank is not an operating expense. This is deducted after estimating operating profit. You must remember this. Now, the first thing that you do is estimate depreciation, not really gross profit. First thing you do is estimate depreciation. So to estimate depreciation, you have to go to the previous year's balance sheet and see what are the long-term assets. Here, non-current asset is the long-term asset. What are there? Land is there. I said land should not be depreciated. Building is there. Building should be depreciated. Plant machinery is there. That should be depreciated. Then preliminary pre-operative expenses. This is nothing but those advertisement expense and all that which you incur. This is to be amortized. This will not be depreciated but amortized. I'll explain in details later. Now, to estimate depreciation, you have to start from balance sheet item, balance sheet data. So for land, there is no depreciation. Now machinery, we start with, suppose, building. We start with building first. Now the building, we start with the previous year's value. It was 1,000 rupees. Where is that? Here, building is 1,000. So we start with that. It is connected to that. Try to have the habit of connecting so that you don't make a mistake. Building is 1,000 rupees. Then if you are buying any new building, that is to be added. So you must have noticed that you have constructed a factory shed. That is green. So that is to be added. So new building added is 300. Now you make a subtotal. If you sold any building, that is to be deducted because those buildings are no longer there. We don't want to depreciate it because the moment we sold, we have already recovered the money. Now that is not to be accounted for. So whatever sales you make, building asset, that is to be deducted. Now this is the total value of the building asset and you depreciate, say at the rate of 5%. At the rate of 5%. Depreciation at the rate of 5%. So building is depreciated at the rate of 5%, 1,300 becomes 65. Deduct that from 1,300 becomes 1,235. This is the book value of building and that goes to the balance sheet here. Where is that? Building is 1,235. Yeah, 1,235. And I have put an arrow here for your understanding. I'll share this document. So if you are not aware as to how this data has come from where, this arrow should be followed. Okay, so 1,235 is the net value after depreciation. That is the book value as of today. That is why it goes to the balance sheet. Anything mentioned in the balance sheet as of date is nothing but the book value. Then machinery. Value as per last year account is 6,800. Where it is? It is right here, 6,800. That is the previous year's value. Whatever is mentioned in the balance sheet is the book value. Now you bought some machine during the year. You bought 12,000 worth of machines. What are that? You look at this green thing. Purchase of equipment is 12,000. So it comes directly from here. So 12,000 worth of machinery has been bought. Then a new truck was bought for 2,500. New truck, purchase of truck. That is also added because truck also is depreciated. Then a telephone was bought for 20 rupees. Then total purchase is 14,520. Subtotal, what subtotal? Oh, that is the total purchase. And previous year balance was 6,800. So subtotal becomes, total becomes 21,320. And you might have noticed that we sold a machine for 2,400 here. Sold old machine for 2,400. So sold during the 2000, this will be deducted because this asset is no longer there with us. So you deduct. So total becomes 18,920. This is to be depreciated. Suppose your depreciation rate is flat 10%, then the depreciation value is 1892. So you deduct 1892 from the depreciable value, you get 17,028. This goes to the balance sheet. 17,028 becomes the next year's fixed asset. Okay. Now what is the total depreciation? depreciation on machine and depreciation on building. These two together is a total depreciation. So total depreciation is 1950, and I have already red mark all the operating expenses. You make a sum total of that. Operating expenses is this. You follow the formula. This one is the operating expenses. All formula is given. You will follow what are operating expenses. Operating profit is nothing but under operating expenses, even depreciation is included. Depreciation is what? Cell number D32. So look at this. Last item is D32. That means depreciation also has been taken into account. Now operating profit is gross profit minus operating expenses. So what is gross profit? D15. D15 is here. Gross profit is 66,500 minus this operating expenses. So it becomes, now whatever, if you deduct that, you will get profit before tax. No, profit, yes, profit before tax. Operating profit. From operating profit, you deduct interest, then you get profit before tax. I don't know why I got confused. Then you pay income tax at the rate of say 30%. On 12,000, that becomes 3,787. So net profit becomes 8,832. Now you decided that you want to pay dividend of 1,000, deduct 1,000 from here and you get 7,836. This is added to the reserves and surplus of this to get this. Now you have so many data of balance sheet. Almost the entire asset side is made. Now you have to do the liability side. You will get the balance sheet. Okay, so this is the end of the class. I have already taken. I'm sure I have taken. Let me see how the figure changes. Okay, so and slide. Thank